Hello and welcome to Portfolio Matters Share Talk. In today's episode, we will be discussing the Canadian copper miner Taseko Mines, which has a very large low-grade open pit mine and also an interesting in situ copper mining operation in Arizona. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Over to you, Keith.
Okay, so Taseko Mines they've got listings all over the world. So the main listing is in Toronto, but they're also listed in London, although frankly, the liquidity is poor, and Frankfurt and New York. Now, this is their main mine, their existing operational mine, which is the Gibraltar open pit mine in Canada, and is the second largest open pit mine in Canada. So the share price is currently around $2.20 Canadian. That gives them a market cap of, in sterling, 360 million, but they've got quite large debts, 180 million, having raised 400 million Canadian dollars last year. And they have a substantial amount of cash, and if they can get the permits to develop their Florence in situ copper mine in Arizona, they now have the cash to fund that development. So they should not need any more financing. But because they have a large amount of debt, their enterprise value is 535 million sterling. And last year, their revenue was around 206 million, and that's H1 annualized. Now, on the basis of the Gibraltar mine alone, these shares are not terribly interesting. The current forward PE ratio, according to Stockopedia, is about 16. And when we do our own calculation, based on Gibraltar alone, these shares do not seem great value. But the Florence copper mine, which is a low-cost in situ copper mine in Arizona, they have done a test, their testing production facility, and their main well produced 1.1 million pounds of copper. And they have now got through all the legal challenges and are awaiting the second environmental permit. And a draft environmental permit is expected in Q3, so imminently. There will then be a consultation period. But once those permits are received, Taseko have the funds necessary to develop Florence, and that could be or would be transformatory. In addition, it has several other big assets, but those are in Canada on tribal lands, and there are going to be problems getting the environmental permits. So, in summary, these shares look good value only if you believe that the Florence in situ mine in Arizona gets built. Okay, so Taseko has been around for a very long time. And during that time, it's had various stock splits. But in the early days, in the mid-90s, it had a very high share price on the back of the New Prosperity mine, which is a big copper gold porphyry and one of the 10 largest undeveloped mines in the world. But we will go into why that has yet to be developed. And frankly, there seems very little prospect that it will ever be developed. The share price has been on a roller coaster ride in the last 5 years. When we go through the results, you'll see that the Gibraltar mine has really failed to be consistently profitable because it is high cost. So when the copper price does well, it is highly geared to the copper price. So it had a strong period in 2016, 2017. Then in 2018, the shares came off as the copper price fell, and also they issued a large number of shares. Then there were various goings on with the new Prosperity Mine, which we will go into. And currently, the company is in dialogue with the Chilcotin Native American nation about the new Prosperity Mine. So they are at least talking to each other after years of litigation. And the company is talking up its prospects of a deal, but we will be skeptical. And then last year, tried to issue 325 million of senior notes, but it was oversubscribed. And actually, they managed to issue 400 million at a lower interest rate. So they're only paying 7%. They redeemed the old notes, which were due 2022, and that gives them, puts them in a strong financial position and able to finance Florence, because the corporate bond market has been very strong. And the latest news is in May, Arizona Appeal Court ruled in favor of the Florence mine and against the town of Florence. The previous administration had tried to block development, and now all appeals are over. And so it's now just with the Environmental Protection Agency. Okay, so why are we looking at Taseko Mines? Well, if you remember our previous discussion of Excelsior, we looked at this table which showed the relative cost of each copper project in North America and the expected return. And you can see Taseko Mines, the Florence copper project, is number 5. It has a life of mine cost of $1.13 per pound of copper, so it's very low cost. Pre-production capex is low and a very high internal rate of return. So we decided to look at the Excelsior, which had the highest rate of return, and is in this main column here. And Taseko is number 2 in terms of net present value divided by pre-production capex. So the Gibraltar mine has a copper grade of 0.22%, which is incredibly low and lower than the threshold at which I thought it was economically possible to mine copper. So how are they doing it? Well, they're doing it via froth flotation, is the way they separate the copper from the ore. Now, how does that work? Well, actually, it's an ancient technique which has been described by the Greeks and Persians. And the idea is that you bind the particles of ore to a hydrophobic substance, so that when you blow air through the mixture, the particles which are bound to a hydrophobic molecule then try and escape from the liquid into the air, and they bind themselves to the air bubbles and then float to the surface. Now, in order to do this, you have to grind the mineral very finely, and we're talking about particle sizes of 0.1 millimeters, at which point they can bind to the bubbles and be carried to the surface. If they're too large and too heavy, they won't bind to the bubbles. And if we look at the next diagram, you get a better idea. So the molecules on the left with the tail, they look like modern detergent molecules. The idea is the head binds to the surfactant on the particles of copper, and then the long alkane tail is hydrophobic and attempts to escape from the water into the air of the bubble. And what you get is each bubble being surrounded by a layer of copper particles, and they get carried to the surface where you can separate them. This is a diagram of the copper separation process, and you'll see that you go through several flotation tanks before ending up in a thickener. And what does the thickener do? Well, the thickener reduces the amount of water in the froth. So initially it comes in at 90 to 98% water, and then you simply use a gravitational process so that the mineral particles tend to settle at the bottom, and you skim off the water at the top. So you reduce the amount of water in the concentrate from about 90 to 98% to 30 to 50%. But you still need quite a lot of water to make the slurry flow. And so the concentrate you're selling is 30 to 50% water. Okay, so moving on, these are the assets that Taseko has. They have the Aley Niobium project that's undeveloped. They have Gibraltar, which is, as we've seen, in operation and has been in operation for many years. It's been operating since 1972, although Taseko bought the mine in 1984. The New Prosperity mine was their big hope. And that's enormous. It's got a 1 billion ton reserve. But it'll probably never be developed, honestly. And then we have Florence, which is the big hope, and actually will be the main focus of this presentation. So let's look at Gibraltar. Now, some of you may remember previously talking about copper porphyries and how this is the distribution chart of copper in a porphyry. And so actually you get this sweet spot about 0.25%, where you get lots of tons of rock at this concentration. And actually you then get lower amounts of low-grade rock. So the distribution chart shows this log normal distribution. And why this is important is you might expect that you could get more copper out by just reducing the grade cutoff. So you'd think, well, I'm getting loads of rock at 0.4%. If I reduce it to 0.2%, I'll get, much more rock, but there'll be even more copper in that. And that's just not true. As you reduce the copper grade below 0.25%, you get less rock. It's actually less ore-bearing rock. Now, this is a picture of the Gibraltar mine, and it's a mess. This really does show a lot of environmental disturbance, and that is important because the other big mine prospect they have, New Prosperity, is on Indian land, and the Indians just don't want this. So Gibraltar produced 26.8 million pounds of copper in Q2 2020. It is forecast to produce 120 million pounds of copper this year and have an average production of around 135 million pounds per annum. The claimed cash costs were about $1.8 a pound, although when we do our own calculation, we will question that. We think it's higher. And the copper head grade is tiny, about 0.22% copper, but as we go through the numbers, you'll see that varies depending on which part of the mine they are operating in. This year, they're forecasting that there will be a 40% increase in copper grades in H2 as they move into higher grade ore sections of the delightfully named Pollyanna pit. So a history of Taseko's ownership of the Gibraltar mine. Well, they bought it for $1 in 1999 and restarted the mine in 2004. Now, this is a very low grade mine which is high cost. And between 2006 and 2013, they invested 800 million Canadian dollars in expanding and modernizing the plant. And you can see the modern processing plants in this picture here. And then in 2010, in order to help fund the development, they sold 25% of the mine to a Japanese consortium. They only own 75% now. And you can see in the bottom right chart, the production pre and post expansion in 2014. And I think you would say that there's a slight but noticeable drop off in production. So Gibraltar produces copper at very low grades, 0.26% they claim, and also a side product of molybdenum. But when we go through the numbers, the value of the molybdenum is really very low compared to the value of the copper. And it's got a 17-year remaining life. Now, it's only economically viable because they are very efficient at mining the ore and because they are close to cheap sources of hydropower. Now, if we look at some of the historic numbers, so the top row is tons mined, and you can see that it's quite inconsistent. Some quarters they mine a lot more than others. So in Q1 2021, they actually mined 32 million tons of rock. But the amount they actually mill is much more consistent. And the reason they mined so much rock in Q1 is that they had a very high strip ratio. So they're mining lots of waste rock. And if we then go down to the head grade, you'll see the head grade varies a lot quarter on quarter. So in Q2 2020, it had a high of 0.28%. But it has been as low as 0.19% in Q1 2021. So there's quite a lot of variation in the rock within the various pits that form the Gibraltar mine. And as they mine different sections, you get large variations in both the copper output and the profitability of the mine. So what really matters is the site operating cost per pound produced. And you can see enormous variations. When they were mining high grades at 0.28%, their price per pound was $1.15. And within 6 months, that price had doubled as they then went on to mine lower grade areas of Gibraltar. Okay, moving on to Florence. So Florence is the big hope. Florence is an in situ leaching project. Now, we've talked about this extensively when we did our share talk on Excelsior, which also have an in situ acid leaching project in Arizona as well. So I won't go through in situ acid leaching in the same depth. But the bottom line is you inject acid down into the rock, it dissolves the copper, and then you pump out the copper bearing pregnant fluid and you process it. And this is a much more efficient way of extracting copper, but you have to have some very specific mineralogy for it to work. So it only works in a few locations, and Arizona is one of them. Crucially, you have to be below the aquifer. Okay, so Taseko own 100% of the project. It's a big project. It contains 1.7 billion pounds of recoverable copper, and they are talking about annual production capacity of 85 million pounds. As we've talked about, they have raised the funding. So once they get the environmental permits, they should start building the plant. And the cash costs should be very low. So C1, 90 cents a pound. So this should be a very profitable project. The CEO in Infuse is talking about first copper in 2023. To prove it works, they have done a production test facility, which consisted of 24 wells, 4 injector wells, 9 recovery wells, and 11 groundwater management wells. And their main recovery well achieved a recovery rate of 1.1 million pounds of copper per annum. When we talked about Excelsior were facing lots of problems. They were facing problems with precipitation, blocking, and actually destroying the pumps, and above all with the calcite, producing carbon dioxide in reaction with the acid, and the carbon dioxide building up pressure down in the ore body and preventing them pumping more acid in. Now, Taseko are not reporting those problems. So their production facility seems to have been a success. And this is the timeline for the project. So this is from the latest corporate presentation, and they were then talking about first production from the first commercial facility in 2022. But in recent interviews, the CEO is talking 2023. And you'll see the CapEx intensity is very low, as it is for all these in situ projects. But as we've seen with Excelsior, the devil is in the detail. It really depends on the mineralogy and whether, in the case of Excelsior, they're having big problems because the acid they're pumping down is reacting with calcite to produce lots of carbon dioxide, which they're having to flush out with water. That does not seem to be the case here. So what is the current status? Well, as we previously discussed, they have issued a $400 million US dollar. So I think I might have said Canadian dollar previously. That's wrong. It's 400 million US dollar bond sale at a yield of 7%, and they're fully funded. Now, in March, the Arizona Appeals Court ruled in favor of the mine, so all legal challenges are over. They have, and they can go ahead if they get the environmental permits, and they've got the first one. They're now awaiting the draft underground injection and control permit, and they're expecting that in Q3, but that will be followed by a period of public consultation. I have looked at the CPR and to check whether there was any calcite in the ore body, and calcite is mentioned, and I'll read this out. Propylitic, that's calcite chlorite epidote, alteration is visible in mafic dike rocks and was reported in exploration holes fringing the deposit. So calcite is fringing the deposit rather than in the deposit, according to my reading of the CPR. And they are not reporting carbon dioxide buildup. And the production test facility seems to have been a success. So it looks like this will be a more successful project than Excelsior Mines project.
Can I just ask a question here, Keith?
Sure.
So obviously their test site is relatively small. We could see how big it was relative to the size of the vehicle and so forth. And how do we know that the calcite chlorite epidote is outside of their whole prospective extractive region, as opposed to just not in that bit?
We don't. Now, the other problem I have with this company, Richard, is that I think it spins a lot. And if they were having problems, how much do I expect them to tell us? And actually, I don't. I think they would be doing their best to hide that.
Yeah, and the other thing that I am no geologist, but if the Excelsior mine is in Arizona, it lends itself to extraction. Is it not likely that it has very similar chemical composition to the Florence mine?
Well, they are quite a long way actually apart,
Right,
and they're not part of the same ore body. So I think
right.
it very much depends on the idiosyncrasies of the ore body, frankly.
Yeah, sure. I get
But
that. Okay.
he's talking about the calcite here in the fringes rather than in the deposit. And as we saw in Excelsior, the calcite is there very much in the deposit.
Yeah.
But you're right, this is an unknown. And we won't really know until they do lots of wells. Okay, now let's go on to New Prosperity, which was their big hope when the company was originally founded back in the 1990s. So it's one of the largest copper gold porphyry discoveries in the world, but is vehemently opposed by the local First Nation, the Chilcotin. And you listen to the CEO, he's been talking up the prospects of getting this done finally, but it's been 25 years that they've been attempting to get this done. Okay, so I'm not going to go into this in great depth, but because if you're really interested, there are very good timelines on the development of this, and it's been going through the Supreme Court and every court in Canada over the last 25 years. They currently have an environment assessment certificate, but there are very commentaries about, how valid that is. What is true is it's an absolutely enormous resource. And this is a timeline. If you're interested, pause and have a read. Right now, also the litigation between mainly by Taseko has been suspended, and there is government facilitated dialogue between Taseko and the Chilcotin, which the CEO is saying is progress. However, I have looked at the newspaper of the First Nation peoples, and frankly, it seems there is very little chance of this going ahead. One of the rulings was establishing the control of the land by the Chilcotin. So they have land rights, as this dialogue is likely to be a dialogue of the deaf. So Taseko wants to proceed with the mine. The Chilcotin want this to go away permanently and want some solution where this doesn't just keep on coming back. And to quote the chairman of Chilcotin, he said, "I never count these guys out. These guys would try to pump oxygen into a dead horse." So the chance of this project proceeding seem vanishingly slim, frankly. Okay, now the other project they have is Yellowhead. And this is also enormous. And this is also in British Columbia. But again, it is on native Indian land. So it would be an open pit mine with a mine life of 25 years, 4.4 billion pounds of copper recoverable, 440,000 ounces of gold. So it is another big copper gold porphyry. However, if they were to get the go ahead to do this, it would require a vast amount of capital, but this is all years in the future. So the bottom line is they have entered into agreement with an unnamed indigenous nation regarding Taseko's intentions to commence the regulatory approval process. So I would put no economic value apart from hope value in getting Yellowhead developed. And when we look at the timelines of development of all these mines, they are many, many years. And they're talking about commencing the approval process. So this would be years and years away. And frankly, I would expect, again, pushback from the owners of the land, the Indian tribe. Current status. The company is focusing its current efforts on advancing the environmental assessment and some additional engineering work in conjunction with ongoing engagement with the local communities, including First Nations. A focus group has been formed between the company and high-level regulators in the appropriate provincial ministries in order to expedite the advancement of the environmental assessment and the permitting of the project. So I think the government would like it to go ahead, but the question is, do the local peoples and the First Nation want it to go ahead? And finally, they have a niobium project. And niobium is one of these new metals used to strengthen steel and is used in aluminium and in strengthening low temperature steel or alloys. And it's the relatively little produced of it, like 78,000 tons a year, mainly from Brazil, used in jet engines, superconducting magnets, etc., etc. Now, their project is actually big. It was acquired by Taseko in 2007. They did an exploratory drilling campaign in 2010 and did a further 65 exploration holes in 2012. A pre-feasibility study was completed in 2014, and actually skipping forward, their timeline from 2015, and they said they were here, and so should have been in operation by roughly 2020. And as it is, we are still there. Nothing has moved on. Going on to the project economics, they would produce niobium with an operating margin of about $21 a kilo, they're saying, and with annual production of 9 million kilos, so 9,000 tons. Now, bear in mind that the total world market is only 78,000 tons. So I think that's probably quite optimistic, because you would undoubtedly affect the niobium price by putting an extra 15% onto the market. But notice the strip ratio is really low. You know, this is quite a concentrated ore body. Also, capital costs are large. So again, you're going to need a lot of capital to get this going. And from the interim report, essentially, I've looked at the last 3 years annual reports, and the wording of the first sentence doesn't change. Aley Niobium project environmental monitoring and product marketing initiatives continue, essentially. So there doesn't seem to be much progress. And, you know, when you look at the project timeline, I mean, don't hold your breath. So let's go through a quick corporate presentation, and they are saying that the Taseko is undervalued based on the NPV of Gibraltar and above all of Florence. And if you look at this, you'll see that actually on Gibraltar alone is pretty close to fair value. The bull case on Taseko really revolves around getting Florence into operation. And this is their timeline. Frankly, Gibraltar being in production by 2025, I think is fanciful. So let's go through their historic numbers. Now, I have got these from Yahoo. And you'll see that historically, it has really struggled to make a consistent profit. So in 2019, it lost money at the gross level. Its gross profit was negative. And then if you look at income from continuing operations, it lost money in 2018, 2019, and 2020. So even during the last cycle, it was losing money. And for a company which has very large depreciation expenses because it's a big mine with lots of capital, I think it talks a lot about EBITDA, but I think EBITDA is very misleading. And if we look at the balance sheet, first of all, notice the very high debt levels, but also the retained earnings. Bear in mind that this company has been in operation since 2004, and since 2004, it has net lost 216 million Canadian dollars. And finally, cash flow. Obviously, the cash flow is much better than earnings because depreciation is very high. But you'll see, we'll find depreciation, that the depreciation has been coming down. So presumably the main investments in the mine are over. And you can see here investments in plant and property have been falling. Again, looking at the most recent interims. Well, most recent interims were actually really quite poor. Production fell very substantially in the 3 months to June from the same period a year ago. But revenues rose because the copper price was very strong. But you see, even with very high copper prices, the first half of 2021, was not terribly profitable because they have been mining a relatively low grade area of the mine. And the company are talking about a 40% increase in copper grades in the second half. And you really need that to drive profitability because right now it's not really very profitable. So you'll see that Q2 2020, you're producing 37 million pounds of copper. And in Q1 2021, that had fallen by, was that a third? Oh, well over a third. So production is really very variable, and that drives a big variability in operating costs. And this is the depreciation and amortization numbers, which are falling. Okay, so let's go into a calculation. So just a quick reminder of what the various costs are. So direct cash costs, C1, represents the cash cost incurred from the direct mining of the metal minus any byproducts. C2 is C1 plus depreciation, depletion, and amortization. And C3 is basically everything, including indirect costs and interest rate charges. Now, they are guiding that C1 was $2.02 a pound. If you're interested, have a look at this, but I don't think that's right. When you go through the numbers, I think it's actually 13% higher. So $2.02 US equals $2.48, and I calculated it at $2.81. So we are going to assume that the real C1 costs throughout this calculation are 15% higher than those declared by the company. I should also add the company has sold a silver stream to Osisco Gold Royalties for upfront cash. So they've sold their silver, basically. I'm going to do an idealized calculation for Taseko, for Gibraltar and Florence. And that will exclude, so let's do an idealized calculation for Taseko Mines with and without the Florence. So in this idealized calculation, we are going to ignore derivatives and FX costs and assume those are volatile and net to zero. We're also going to assume that Gibraltar has an annual run rate of 120 million pounds of copper per annum as per guidance, bearing in mind in Q2 the annualized rate was only 100 million. We are also going to assume that the Canadian tax rate is 27% and there's an additional Colombian mineral tax of 9.5% for a total tax rate of 36.5%. It was actually slightly lower than that in Q2. We will also assume that Florence produces at 75 million pounds per annum, not the 85 million pounds forecast, and that Florence C1 costs are 15% higher as per our adjusted calculation for Gibraltar. And we will also assume that the financing costs are unchanged. So we're going to use the Q2 interims as our guide for the production costs in Gibraltar and the financing costs. So using those numbers and assuming production is from Gibraltar only, and copper is $4 a pound, then we get decent profitability, but not very interesting. A P ratio of 12.3. So expensive. If we assume copper at 4.5, then that comes down to 7.3, which is again, frankly, not terribly interesting. If we now assume that Florence is in operation and we calculate the cost of sales based on their C1 adjusted C1 costs, then at $4 copper, we get to good value. P ratio of 3.5. At $4.5 copper, interesting, 2.5. So really, in order to see Taseko as being good value, you have to assume that Florence comes into operation in line with guidance and that the copper price stays at least $4. Anything below $4, this is a high cost operation and the shares do not represent good value. These are the historic numbers, and to reiterate, you can see that historically this mine has struggled with profitability and has high debts. So turning to the positives and negatives, Gibraltar is a high cost mine, and that means Taseko is highly leveraged to the copper price. It is, however, in a safe jurisdiction, and it has a portfolio of assets in safe jurisdictions if it can get them developed. Florence looks like a very interesting project, and the production test facility seems to have gone well. And all that now remains is for them to get the permits, the environmental permits. The legal process seems to have been finished and they're fully funded. And the CEO is talking about first production in 2023. And medium term, Yellowhead and Aley may provide potential upside. The negatives, well, this is a very high cost mine that has struggled with its profitability historically. If you look at retained earnings, then since the mine restarted in 2004, it has lost money. It's lost 200 odd million in retained earnings. So bottom line is, this has been unprofitable for shareholders. The new Prosperity mine is unlikely to ever be built based on my reading of the outsized news sources. Although the CEO has talked up recent developments, I don't believe that. I think it's very unlikely New Prosperity ever gets built. And Yellowhead also has issues with First Nations. So there are big question marks about whether Yellowhead ever gets developed either. And Florence, everything depends on Florence, and Florence is yet to be fully permitted. So if you're investing in Taseko, you really are gambling that the environmental permit will be issued and that Florence will go ahead, because if it isn't issued, then these shares are A, not good value, and B, they've got very high financing costs and they've got a lot of debt. Richard, your thoughts?
Yeah, thank you very much, Keith, for a very detailed and interesting presentation. I think you sort of hit the nail on the head when you said it all depends on Florence. So Gibraltar is doing projected to do fine, effectively. If we assume that the copper price doesn't go up, Florence is a tremendous resource and with low cost of production. But we personally, I think, have some question marks over the extraction method after understanding the difficulties that Excelsior have had, which is not to say that they will have the same problems, but one would like to see it actually working at some sort of a scale before being convinced that it's going to go without any difficulties, assuming they get the final permitting sorted out. The other prospects seem to be really highly prospective, and it's difficult to count them into the net present value of the business at the moment. And as you rightly say, with niobium, if they're going to produce 15% of the world's demand, what does that do to the price? Presumably, it trashes it to some extent.
Yes.
All copper producers will become cash cows if the copper price doubles. I'm not sure how Taseko is differentiated from any others in that respect. So it's what is it? It is probably ongoing a copper producer with a decent rate of return. It has prospects which may prove to be highly valuable, but also which may not come to fruition, and therefore has an element of risk about it. So I suppose the return from Gibraltar de-risks your investment, but whether you're going to get a significant capital appreciation on the upside from the other projects is uncertain.
Yeah. And I think Florence looks a great prospect, but it's tied to a very high cost, low grade mine in Gibraltar.
Yeah.
And so this looks like a high risk, medium return investment, actually, because if the copper price were to turn down, and I've seen various reports that although the copper price has a good long-term outlook, there are reasons to believe that over the next couple of years it could be weaker, or as new projects come online. And if the copper price dips below $4, then really Gibraltar looks very poor, frankly.
That's right, Keith. And also, the management doesn't have a huge track record of sticking to their timetables in terms of managing the developments. So there has to be a question mark over the timescales that they're putting on the development of these projects as of now. And so that's another degree of uncertainty within the business case for it. Yeah,
no, I completely agree. When you look at that, the development map, was it for Yellowhead, and it's exactly the same as it was 5 years ago. That's not very encouraging. Okay, thank you all for watching, and please can you press like and subscribe to the channel. And it is goodbye from Richard Wheater.
And it is goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.